Emerging markets is a vast universe of 25 countries. It's half of global GDP and about 2/3 of the global population. And you've got this huge range of countries within this index, all the way from tech superstars like Taiwan, South Korea, all the way down to domestically driven economies like Philippines and India. And so you've got to be really careful. You can't just be a stock picker in this asset class. Classic example was Russia. At the beginning, on the eve of Russia's invasion of Ukraine. You could have been the best stock picker in the world and you still lost all your capital. So it's about being in the right markets. So the strategy, for example, currently has nothing in Turkey, South Africa, the EM periphery. Rule number one, protect capital. And then that's the key to long-term performance. So you've got to get the country selection right, and we spend a lot of time researching the economies, the politics of the emerging markets, so we can position the strategy appropriately for the best sovereign risk, the best country allocation in any given environment. So we recently visited Taiwan and South Korea. Some similarities here, they're both absolute tech powerhouses. There's a lot of excitement at the moment around AI, and we see in the headlines NVIDIA, Apple with Siri and the latest generation of iPhones that's going to come out this year. But let's not forget that for both NVIDIA and Apple and every other AI company, who's making the chips? Apple doesn't manufacture the chips, and NVIDIA doesn't manufacture the chips, both design companies. In fact, when we think of the leading logic chips, so these are the chips that power AI, there's only two companies in the world that can manufacture those. TSMC in Taiwan and Samsung Electronics in South Korea. These are the two companies in the world. If you look at NVIDIA's top AI chips, which are developing so much excitement at the moment around machine learning and the applications, ChatGPT, 100% of the leading AI chips are manufactured in a single fab in central Taiwan, which I visited with one of the other portfolio managers recently. And so we see this disconnect between all the hype around some of the US listed names, Apple, NVIDIA, and so on, and the companies that are actually manufacturing the chips in valuation. So you can buy a Samsung on a low teens multiple compared to the sky high valuation. NVIDIA is almost $1 trillion market cap because of the excitement around AI, which is more than the market cap of Samsung and TSMC combined, even though these are the companies that are making the chips. So we think actually the smart way to play this AI theme, which we believe in, it's the next technological revolution, is actually to buy the companies that make the chips. Now, the other thing that builds into what we're seeing in technology, not just AI, but also cloud computing, is DRAM, which is a form of memory. Now, there's 3 companies in the world that can manufacture leading DRAM. It's so technologically advanced. There's only 3 companies. And 2 of the 3 companies are South Korean. Samsung Electronics, SK Hynix, both are in our portfolio. So we're very optimistic, bullish on the structural theme of chipification, the computerization of everything. And so we're going to have more and more data. We're going to have more and more computer processing power, compute, as they call it broadly, and that's going to require more and more logic chips and memory. And really, as this becomes more and more advanced, it's harder and harder for companies to compete. So China is completely out of the picture here. In the case of logic chips, 20 years ago, this was dominated by Intel, but Intel's already dropped off the peloton. It's really now down to just TSMC and Samsung, those 2 names. Both of which are in the portfolio. So we have high conviction on those investments, and that's just not reflected in valuation. Interestingly, in the case of Taiwan, we did a number of political meetings as well. It's a geopolitical flashpoint, absolutely, as we all know. But the Taiwanese government has restricted TSMC from manufacturing leading chips outside of the country. So 100% of the leading chips are manufactured within Taiwan. The latest iPhone that will be released before Christmas this year, 100% of the chips, the computer chips for the iPhone, are manufactured in Taiwan. 100% of AI chips for NVIDIA in Taiwan. That creates a powerful reason, a powerful rationale for the US to defend Taiwan. So it's a very smart policy by the Taiwanese government, and we think it reduces the risk of a miscalculation by China. The era of cheap money, quantitative easing, zero interest rate policy, that's come to an end, unequivocally. And so that means we're back to fundamentals. We're taking away the tailwind of money printing. And when we're back to fundamentals, the fundamentals are better in emerging markets. Better demographics, better structural growth, better volume growth for companies that operate in these countries, and superior valuations. Let's not forget, emerging markets for a long time traded on a big premium to developed markets. Now you're able to buy emerging market stocks with much higher structural growth than their developed market peers at a discount to developed market stocks. But with these great fundamentals, you still have idiosyncrasies with emerging markets. Very complex. Politics matters a lot more in emerging markets than it does in developed markets. And Indonesia is very different from South Korea, which is very different from Brazil, which is different from Mexico. And so this really is an asset class where you need a specialist. It's not an asset class historically that's been fruitful for global investors who try and get a bit of exposure to emerging markets because they lack the specialist skill required to differentiate between countries and within a country understand which groups are best placed to win. It's also a better way to play this theme is by buying emerging market companies. You can't just buy Apple because they have exposure to emerging markets, because we have this valuation mismatch. If you're buying emerging market growth through DM listed companies, you're paying a big premium because of the tailwind of QE and because of the distortion of easy monetary policy. You've actually got to buy those fundamentals, the demographics, the structural growth, through emerging market companies listed in emerging markets. And that requires a real specialist approach.